Silver above all-time highs, the China-driven squeeze reshaping global markets. In late 2025, the global financial system found itself wrestling with a phenomenon that defied the traditional logic of commodity markets, a situation analysts and historians may one day look back upon as the Great Silver Squeeze. For decades, silver was treated as the volatile, poorer cousin of gold, a hybrid asset that fluctuated between being a monetary hedge and an industrial input. However, as the year 2025 unfolded, the market entered a state of profound dislocation. Prices skyrocketed, shattering records not seen since the Hunt brothers cornered the market in 1980. Yet this was not merely a speculative bubble. It was the physical manifestation of a global liquidity trap, driven by a structural deficit that had persisted for 5 consecutive years, and most critically, by the industrial dominance of China. To understand the magnitude of this liquidity trap, one must look beyond the ticker tape of spot prices and into the mechanics of the physical supply chain. A liquidity trap in a commodities market occurs when rising prices fail to mobilize new supply and instead trigger hoarding behavior that exacerbates scarcity. By October 2025, this is exactly what was occurring in London and New York. The lease rates for silver, the interest paid to borrow physical metal, had exploded from a sedate fraction of a percent to annualized rates exceeding 30 and even 40%. This statistical anomaly signaled a breakdown in the plumbing of the global financial system. It meant that despite nominal prices reaching all-time highs, there was almost no physical metal available for the wholesale market to move. The vaults were not empty, but the metal inside them was frozen, locked away by exchange-traded funds, strategic state reserves, and industrial stockpiles, creating a vacuum where the free float used to be. At the epicenter of this vacuum sits the People's Republic of China. The narrative of the 2025 silver squeeze is inextricably linked to China's industrial strategy, particularly its calculated shift away from quantity-driven competition toward value-driven development. This policy shift, termed anti-involution by the Chinese government, fundamentally altered the economics of the solar photovoltaic industry, which serves as the primary engine of global silver consumption. In 2024, China added a record 278 gigawatts of solar capacity, cementing its status as the unparalleled hegemon of green energy manufacturing. However, the unchecked expansion of previous years had led to fierce price wars and overcapacity in the polysilicon and wafer sectors. In response, the China Photovoltaic Industry Association, CPIA, under the guidance of the Ministry of Industry and Information Technology, intervened in 2025 to curb this chaotic expansion. The result was a decline in the growth rate of Chinese photovoltaic manufacturing for the first time in over a decade, a counterintuitive move that many Western analysts initially misread as a sign of waning demand. In reality, it was a consolidation of power. While the output of raw polysilicon dropped by nearly 30% in the first 10 months of 2025, the production of solar modules, the finished products that require silver paste, continued to rise by over 13%. By regulating the upstream supply chain while maintaining downstream output, China effectively ring-fenced its silver consumption. The metal was no longer flowing freely through international markets. It was being absorbed into a vertically integrated state-guided industrial loop designed to dominate the global energy transition. This strategic recalibration in Beijing coincided with a relentless surge in demand from the automotive sector. The transition to electric vehicles represents a multiplier effect on silver consumption that the mining industry was ill-equipped to handle. An average battery electric vehicle requires between 25 and 50 grams of silver, which is approximately 67 to 79% more than a traditional internal combustion engine vehicle. By 2025, electric vehicles were on track to overtake traditional cars as the primary source of automotive silver demand. This demand is famously price inelastic. A manufacturer building a $50,000 electric vehicle will not halt production because the $30 worth of silver in the battery management system has risen to $60. They simply pay the price, securing inventory at any cost to keep assembly lines moving. The intensity of this demand is further compounded by the digital revolution. The proliferation of artificial intelligence and the expansion of data centers have created a voracious appetite for high-performance semiconductors and circuit boards, all of which rely on silver's unequaled electrical conductivity. Global information technology power capacity has surged more than 50-fold since the turn of the millennium, and the sophisticated chips driving generative AI require advanced packaging that is silver-intensive. China's push for semiconductor self-sufficiency, bolstered by massive state funds like the $47 billion Big Fund III, has ensured that a vast quantity of the world's silver flows into domestic technology hubs rather than international exchanges. While the demand side of the equation was being rewritten by Chinese industrial policy, the supply side was collapsing under the weight of chronic underinvestment. Global silver mine production grew by less than 1% in 2024, a negligible increase that failed to make a dent in the structural deficit. The reality of geology is unforgiving, permitting timelines for new mines in primary jurisdictions like Mexico and Peru now stretch to a decade or more, and ore grades are in secular decline. For 5 consecutive years, the world consumed more silver than it dug out of the ground, a deficit that by 2025 amounted to nearly a full year's worth of global mine production. This persistent shortfall forced the market to cannibalize its own inventories. In London, the vaults of the London Bullion Market Association, traditionally the reservoir of last resort for the Western world, saw inventories plummet to multi-year lows. By August 2025, the volume of silver held in London had fallen by 7.5% year-on-year. More alarmingly, the free float, the metal not already leased out or held by exchange-traded funds, had effectively evaporated. This physical scarcity migrated to New York, where the COMEX exchange faced a crisis of confidence. The registered category of silver, which represents metal warranted and available for immediate delivery against futures contracts, dropped to just 36% of total inventories. The depletion of Western vaults exposed a critical vulnerability in the global supply chain, the concentration of refining capacity. While silver is mined in the Americas and Australia, a staggering 40% of global refining capacity resides in China. This created a bottleneck where raw concentrates were shipped east for processing, but the refined, good delivery bars required by Western banks did not return. They remained in Asia to feed the solar and electronics giants. When Western investors sought to secure physical metal to back their trades, they found that the refining infrastructure outside of China was at maximum capacity and unable to process scrap or doré bars fast enough to meet the liquidity needs of the market. The result was a bifurcation of the global price mechanism, a phenomenon that shattered the illusion of a unified world market. A persistent premium emerged on the Shanghai Gold Exchange, where silver traded at significantly higher prices than in London or New York. At times, this arbitrage gap exceeded $3 per ounce, a disparity that would normally be closed by traders buying in the West and selling in the East. However, in 2025, the arbitrage mechanism broke down. The physical scarcity in London meant there was simply no metal to ship, and the logistical nightmare of transporting heavy bullion by air freight to capture the premium proved too costly and complex for traditional arbitrageurs. This geographic fracture allowed China to effectively set the floor price for silver, driven by the physical realities of its industrial base rather than the paper speculation of Western derivatives markets. The Shanghai price reflected the true cost of securing the metal needed to build the world's solar panels and electric fleets, while the Western price lagged, anchored by paper contracts that were increasingly detached from physical reality. This divergence was a clear signal that pricing power had shifted from the financial hubs of the West to the industrial hubs of the East. The psychological impact of this shift on Western investors cannot be overstated. As the realization set in that silver was no longer just a precious metal but a strategic industrial asset, investment demand surged. Exchange-traded products absorbed nearly 200 million ounces of silver in the first 10 months of 2025 alone. This investment demand acted as a feedback loop, deepening the liquidity trap. As investors bought ETF shares, the funds were contractually obligated to source physical bars to back them. This sequestered yet more metal in vaults, removing it from the industrial supply chain, spiking lease rates further and driving prices even higher. The situation was exacerbated by the geopolitical climate. The United States government, recognizing the peril of its position, designated silver as a critical mineral, acknowledging its indispensability to national security and energy independence. This move, while necessary, signaled to the market that the government anticipated shortages. Simultaneously, reports emerged of China implementing export restrictions on silver bullion, a defensive measure to ensure its own manufacturers had priority access to the metal. This weaponization of the supply chain transformed the silver market from a venue of financial speculation into a theater of geopolitical conflict. The concept of the liquidity trap, in this context, is distinct from its macroeconomic definition involving interest rates. Here, it refers to the paralysis of the physical flow of goods. In a functioning market, a high price acts as a signal to bring more supply to market. Miners dig faster, and holders of old silver sell it for scrap. But in 2025, the supply response was broken. Miners could not dig faster due to the decade-long lead times for new projects. Holders of silver were not selling, they were hoarding, spooked by the debasement of currencies and the fragility of the financial system. And the scrap supply, while growing, was constrained by the limits of refining capacity outside of China. Consequently, high prices did not cure high prices. Instead, they signaled distress. The explosion in lease rates to 40% paralyzed the very institutions meant to provide liquidity. Refiners and mints, which typically lease metal to manage their workflows, found that the cost of borrowing silver exceeded their profit margins. Production lines for retail coins and bars slowed or halted, creating shortages of physical product for retail investors even as the spot price climbed. This disconnect between the paper price of silver and the cost to actually obtain a physical ounce became the defining characteristic of the squeeze. The implications of this squeeze extended far beyond the trading pits of Chicago and London. It began to bleed into the real economy through a process known as greenflation. As silver is a non-negotiable input for green technologies, the rising cost of the metal threatened to inflate the cost of the energy transition itself. Solar panel manufacturers, operating on razor-thin margins, faced the prospect of raising prices, potentially slowing the deployment of renewable energy capacity globally. For the automotive industry, the silver squeeze added another layer of cost to electric vehicles at a time when affordability was the main barrier to mass adoption. Furthermore, the squeeze exposed the fragility of just-in-time supply chains in an era of strategic competition. For decades, Western industries had relied on the assumption that they could always source commodities from the global market at the prevailing price. The events of 2025 shattered this assumption. Industrial users found themselves facing industrial credit scarcity, where the capital required to secure silver inventory became prohibitive. Smaller manufacturers in the electronics sector faced existential threats, unable to finance the raw materials needed to keep factories running. The role of the BRICS nations in this dynamic further complicated the picture. Central banks in these emerging economies had been aggressively accumulating gold and silver as part of a broader de-dollarization strategy. By diversifying their reserves into tangible assets, they reduced their exposure to the US dollar and the Western financial system. This official sector buying placed a firm floor under prices and removed substantial quantities of metal from the open market. It was a vote of no confidence in fiat currency that resonated with private investors, fueling the debasement trade that drove ETF inflows. As the year drew to a close, the silver market remained in blue sky territory, trading at levels that had no historical resistance. The consensus among analysts was that the structural deficit would persist. There was no quick fix. Building new mines would take years. Building new refineries outside of China would take nearly as long. The substitution of silver with cheaper metals like copper in solar panels and electronics had reached its technical limits. Further thrifting risked compromising the efficiency and reliability of the hardware, a risk manufacturers were unwilling to take in safety-critical applications like autonomous vehicles. The 2025 silver squeeze serves as a stark illustration of the new economic reality. It demonstrated that control over the processing and refining of critical materials is as important, if not more so, than the mining of the raw ore. China's dominance in this midstream sector allowed it to insulate its domestic industries from the worst effects of the squeeze, while the rest of the world scrambled for metal. The liquidity trap that ensnared the global market was not an accident of nature, but the result of a decade of divergent industrial policies, strategic integration in the East versus financialization and outsourcing in the West. In this new paradigm, silver has graduated from being a mere commodity to a strategic asset of the highest order. The squeeze of 2025 was the moment the market realized that the paper claims on silver vastly outnumbered the physical bars available to satisfy them. It was a run on the bank, but the bank was the global industrial supply chain, and the currency was the most conductive metal on Earth. As the world moves deeper into the digital and green ages, the lessons of this liquidity trap will likely reverberate through every commodity market essential to the future of technology and energy.